Hi, what I want to do now is to talk very quickly about another type of asset which is accounted for with its own accounting standard, and that's investment properties. In considering how investment properties are going to be accounted for, whether they're going to be accounted for on an historic cost basis or a current value basis, what we need to think about is what is the asset, what is the business model, what's the duration over which the assets are held, and are there likely to be material changes in value. It's probably fair to say that in relation to investment properties, these assets tend to be held to increase in value and to provide rents. So price change is something which is seen as part of their business model. The assets are often held for long periods of time, and there are often substantial changes in value. This would, to me, suggest that it's more likely to be a current value or a fair value type standard rather than historic cost standard. And it's probably likely that there are sufficient transactions of investment properties that an attempt can be made to try and value these properties. And in fact, these properties are valued all the time as part of security and the like. So it's likely that it's going to be a fair value standard. If it's a fair value standard, then it's going to have to address just two basic things. One, recognize the asset at fair value. Two, changes go to the statement of profit or loss. So let's get into the standard and see what it actually says. What we're talking about here is IAS 40, AASB 140, and this is specifically concerned with investment properties. The scope of the standard is outlined in paragraph 2, and the definitions are in paragraph 5. Critically, what this identifies is this standard applies to investment properties. That's where you buy a property and hold it with the intention of generating returns through rental and through gains. And the properties may be owned freehold, or alternatively it may be an investment in a leasehold property. Now the challenge here is that if you have some investment properties which are owned outright and some you merely own the leasehold on a property, you need to have them accounted for in the same manner so as to make them comparable. You can't have different accounting practices for assets which are essentially similar in nature. What we'll see here is that there's also a definition of fair value, which is the price that we pay between a willing buyer and a willing seller in an orderly market. And this is dictated under IFRS 13, AASB 13, and this is specifically concerned with fair value measurement. So what we can already see from these definitions is that our initial suspicions that it's going to be a fair value standard are being confirmed. And so the issue then becomes one of when do we recognize the asset? And then recognizing it at fair value, and of course gains and losses go to the statement of profit or loss. So let's see how that happens. Not surprisingly, the first issue which has to be addressed in relation to any asset is does it meet the criteria for recognition? And the criteria are pretty straightforward for investment properties. There must be future benefits and cost can be reliably measured. Probably costs in there because when you initially recognize an investment property, it's going to be recognized at cost, which is the fair value at the date of the initial recognition. So we initially recognize an investment property at cost, and this includes transaction costs. And the intuition here is that whilst it might seem like this is saying it's going to be a cost standard, what it's really saying is that cost is the fair value at the date of the transaction. So we initially recognize the property at its transaction value. Subsequently, we use a fair value model or a cost model. And the fair value model is outlined quite clearly, which says that we measure the assets at fair value in accordance with paragraph 33, and gains or losses go to the P&L. So that's really all the standard is doing in terms of fair value accounting. Value the assets at fair value, gains or losses go to the P&L, and once again it creates a seductive simplicity in the standard. There are exceptions if fair value may not be reliably determined, and then historic cost may be substitutable. There's also the choice or the option for investment properties to be accounted for under the cost model. The standard itself doesn't talk in much detail about what this would be because it says the cost model is already addressed in the accounting practices required for property, plant and equipment, and this stipulates that you recognise the assets at cost, and it defines what that cost is. They're subject to limits on what can be carried forward impairment, and there's a depreciation charge. But in firms that invest in investment properties, real estate investment trusts, overwhelmingly use the fair value approach rather than the cost approach. And this largely reflects the fact that this captures the nature of their business, which is investing in properties for gains through rental and through capital appreciation. And both of those should go through the income statement. The disclosures are pretty straightforward. You have to identify whether you use the cost or the fair value model for your investment properties. You need to identify the profit loss items relating to the investment properties. Rental income, quite obviously, but it's also going to include if fair value accounting is used, fair value gains or losses, depreciation if you use the cost model. So it's pretty straightforward, and investment property operating expenses. And there's also required to be a reconciliation of changes in the balances of the assets. So you can appreciate how the assets are changing in value and what's causing that change in value.